Welcome to this lecture on key financial ratios and valuation metrics. Today we'll focus on how these essential tools help assess a company's financial health and guide trading decisions. By understanding these metrics, traders can determine whether a stock is worth buying, holding, or selling. We'll explore their practical applications and how they provide valuable insight into market opportunities. Let's dive in and enhance our ability to make informed trading decisions. Understanding financial ratios is crucial for making informed trading decisions. These ratios help traders identify undervalued or overvalued stocks, assess a company's financial health, and determine growth potential. Growth investors often seek companies with high return on equity, steady revenue growth, and strong market confidence. Traders also look for high PE ratios as potential trading opportunities, signaling market optimism and momentum. On the other hand, value investors focus on low PE and PB ratios to find undervalued stocks, aiming for long-term gains. Profitability ratios, like the net profit margin, are essential for traders in assessing a company's ability to generate profits from its revenue. A higher net profit margin indicates strong cost efficiency or pricing power, both of which can be positive signals for traders. Traders use this metric to identify companies with sustainable profitability, which can lead to long-term stock growth. A rising net profit margin often suggests improving financial health, making the stock more attractive for trading opportunities. By analyzing this ratio, traders can better evaluate whether a company is a strong trade or if potential risks exist. Profitability ratios play a crucial role in stock trading by helping traders assess a company's financial strength and growth potential. Growth traders look for companies with expanding profit margins, as they signal strong operational efficiency and pricing power. On the other hand, a declining net profit margin can serve as a warning sign, indicating cost pressures or weakening demand. In the example, a trader analyzing two competitors may choose to go long on company A, given its rising 12% profit margin, while avoiding company B due to stagnant profitability. Return on equity, ROE, is a key profitability metric that helps traders evaluate how efficiently a company generates profits using shareholders' equity. A higher ROE indicates strong management performance and effective capital utilization, making the stock more attractive for trading opportunities. Traders often seek companies with consistently high ROE, as it signals financial strength and potential for stock price growth. Conversely, a declining ROE may suggest poor management decisions or financial struggles, serving as a warning sign for traders. Return on equity is a crucial metric for traders looking to identify strong trading opportunities. Growth traders focus on companies with consistently high or improving ROE, as it reflects efficient management and profitability. A declining ROE, on the other hand, can signal financial struggles or poor management decisions, which may indicate a weaker stock. In this example, a trader analyzes two companies and chooses to go long on company X due to its strong 25% ROE, while avoiding or shorting company Y because of its lower ROE and high debt. Return on assets, ROA, is an essential metric for traders to evaluate how efficiently a company utilizes its assets to generate profits. A higher ROA indicates strong asset management and operational efficiency, making the stock more attractive for trading opportunities. Traders look for companies with consistently high or improving ROA, as it suggests better asset utilization and profitability. On the other hand, a low or declining ROA can signal inefficiencies or financial struggles, which may indicate a weaker stock. Return on assets is a key metric that helps traders evaluate how efficiently a company utilizes its assets to generate profits, especially in asset-heavy industries like manufacturing. Traders favor companies with rising ROA, as it signals improved operational efficiency and stronger potential for stock growth. A consistently low ROA may indicate inefficiencies, such as underutilized factories or poor capital management, making the stock less attractive for trading. If a company reports low ROA over multiple quarters, It can be a warning sign for traders to avoid or short the stock. Liquidity ratios, like the current ratio, are essential for traders to assess a company's short-term financial health and ability to meet its liabilities. A current ratio above 1 indicates that the company has sufficient short-term assets to cover its debts, making it a more stable trading opportunity. On the other hand, a ratio below 1 may signal liquidity issues, raising concerns about the company's ability to manage financial obligations. Traders use this metric to identify financially stable companies that can withstand market fluctuations while avoiding those at risk of cash flow problems. Liquidity ratios are crucial for traders to evaluate a company's ability to manage short-term financial obligations. Traders typically avoid companies with liquidity issues, as these businesses may struggle to pay suppliers or cover operational costs, especially in uncertain market conditions. A high current ratio can signal strong cash flow, which supports dividend payments and share buybacks, making the stock more attractive for trading opportunities. In the example, a trader identifies company A with a low current ratio of 0.7, indicating potential cash flow problems. As a result, the trader may avoid buying or even short the stock, anticipating further financial struggles. The quick ratio is a key liquidity measure that helps traders assess a company's ability to meet short-term obligations without relying on inventory. Since inventory may take time to sell, this ratio provides a clearer picture of immediate financial stability. Traders pay close attention to the quick ratio, especially in industries with slow inventory turnover, as a low ratio could signal potential cash flow problems. A company with a strong quick ratio is generally more financially flexible, making it a safer choice for trading. The quick ratio is a valuable liquidity metric that helps traders assess whether a company can meet short-term obligations without relying on inventory sales. This is especially important for industries with large inventories, as a low quick ratio may signal potential financial struggles if sales slow down. In the example, a retailer with a quick ratio of 0.5 could face liquidity issues, making it a risky trade. Traders use this information to anticipate potential earnings declines and may sell the stock before poor financial results are announced. The debt-to-equity (DE) ratio is a key solvency measure that helps traders understand how heavily a company relies on debt financing compared to its equity. A high DE ratio often indicates greater risk, particularly when interest rates are rising, as debt payments can become more expensive. Traders watch this ratio to gauge a company's long-term financial stability and its ability to withstand economic downturns. Companies with lower DE ratios typically carry less risk, which can make their stocks more attractive to traders. By analyzing DE ratios, traders can better decide whether to go long, short, or avoid a particular stock altogether. The debt-to-equity (DEE) ratio is a critical tool for traders to assess a company's financial stability, especially in rising interest rate environments. Traders generally avoid highly leveraged companies, as excessive debt can lead to higher interest expenses and reduced profitability. In the example, an airline company with a DE ratio of 4.0, compared to its peers averaging 1.5, signals a higher risk of financial strain. This could prompt traders to short the stock, anticipating that increasing debt costs will erode earnings. By analyzing the DE ratio, traders can identify risky stocks to avoid or short, while seeking more financially stable opportunities for long trades. The price-to-earnings (PE) ratio is a key valuation metric that helps traders assess a stock's growth potential and market sentiment. A high PE ratio suggests that traders expect strong future earnings growth, making the stock attractive for momentum trading. Conversely, a low PE ratio may indicate undervaluation, presenting a potential buying opportunity for traders looking for discounted stocks. Understanding PE ratios allows traders to gauge whether a stock is overvalued or undervalued in comparison to its peers. The price-to-earnings (PE) ratio is a crucial tool for traders to evaluate whether a stock is overvalued or undervalued. Growth traders focus on stocks with high PE ratios, particularly in sectors like technology, where strong future earnings growth is expected. On the other hand, traders looking for undervalued opportunities seek stocks with low PE ratios, aiming to buy at a discount before the market corrects its price. In the example, a company with a PE of 12 trades below its sector, average of 20, signaling a potential opportunity. The price-to-book (PB) ratio is a key metric traders use to identify undervalued stocks, particularly in asset-heavy industries like real estate. A PB ratio below 1 suggests that a stock is trading below its book value, which may indicate an opportunity for traders seeking discounted stocks. In the example, a real estate company has a PB ratio of 0.8, while the market average is 1.5, signaling potential undervaluation. A trader might buy the stock, expecting the market to correct its price over time. Dividend yield is an important metric for traders looking to assess the income potential and stability of a stock. Traders who focus on steady income may favor stocks with high and stable dividend yields, particularly in uncertain market conditions. Growth traders, on the other hand, often prefer companies that reinvest earnings into expansion, though consistent dividends can still indicate strong financial health. During volatile markets, traders may shift towards high-dividend stocks in sectors like utilities and consumer staples for stability. The PEG ratio is a valuable tool for traders, as it refines the PE ratio by incorporating a company's earnings growth rate. This adjustment helps traders determine whether a stock is fairly valued relative to its growth potential. A PEG ratio below 1 often signals an undervalued stock, presenting a potential buying opportunity, while a PEG above 2 may indicate overvaluation. Growth traders use this metric to avoid overpaying for stocks with high PE ratios but weak earnings growth. By analyzing the PEG ratio, traders can make smarter decisions on which stocks offer the best balance between price and future earnings potential. The PEG ratio helps traders assess whether a stock is fairly valued by considering both its price-to-earnings ratio and expected earnings growth. In the first example, Company A has a PEG ratio of 0.8, which is below 1, signaling that it may be a good growth opportunity at a reasonable price, potentially a buy signal for traders. In contrast, Company B has a PEG ratio of 3.0, indicating overvaluation since its price is rising faster than its earnings growth. A PEG above 2 often suggests that traders should be cautious, as the stock may be overpriced, leading to potential selling or shorting opportunities. By analyzing the PEG ratio, traders can avoid overpaying for stocks and identify those with strong growth potential at fair valuations. The earnings growth (EG) ratio helps traders determine how much growth they're getting for the price they pay. A higher EG ratio suggests a better balance between stock price and earnings growth, making it a useful metric for identifying cost-effective trades. Since it is the inverse of the PEG ratio, it provides a different perspective on valuation by emphasizing growth efficiency rather than price overvaluation. Traders use this ratio to spot stocks that offer strong growth potential at a fair price. By analyzing the EG ratio, traders can make more informed decisions on whether a stock is a worthwhile buy or if its growth potential is not justified by its price. The earnings growth (EG) ratio is a powerful tool for traders looking to identify stocks that offer strong growth potential relative to their price. A higher EG ratio suggests that traders are getting more earnings growth for every dollar spent on a stock, making it a valuable screening metric. Unlike relying solely on PE ratios, the EG ratio helps traders uncover opportunities that may not be immediately obvious. In the example, Company A has an EG ratio of 2.0. indicating a strong balance between price and growth, making it an attractive trade. By using the EG ratio, traders can make more informed decisions and avoid overpaying for stocks with weak growth potential. This analysis of Amazon's stock from 2015 to 2022 provides traders with a data-driven perspective on how financial metrics align with stock price movements. By examining key ratios and trends, traders can identify patterns that contributed to Amazon's explosive growth in e-commerce, cloud services, AWS, and global expansion. Understanding these financial metrics helps traders anticipate similar growth opportunities in other stocks. Amazon's stock performance during this period highlights the importance of analyzing financial data to make informed trading decisions. By studying past trends, traders can develop strategies to capitalize on future market movements. Amazon's net profit margin remained low in its early years as the company prioritized growth and reinvestment over immediate profitability. However, from 2019 to 2021, margins increased significantly due to the success of AWS and improved operational efficiency, signaling stronger financial performance. Traders analyzing Amazon during 2015-2018 should have focused on growth-oriented metrics rather than just profitability, as the company's long-term strategy was expansion. By 2019-2021, rising profit margins would have been a key indicator of improved profitability, supporting a bullish outlook on the stock. Amazon's return on equity, ROE, steadily increased as net income and reinvested profits expanded, signaling improved efficiency in generating returns from equity. By 2017, Amazon had achieved a consistent double-digit ROE, showing that it was effectively using its capital to drive profitability. Between 2017 and 2019, traders would have recognized this shift from aggressive expansion to sustainable profitability, marking a key turning point for the stock. This rising ROE would have been a strong buy signal, as it indicated the company's growing financial strength. By tracking ROE trends, traders can identify companies transitioning into profitable phases and capitalize on long-term stock growth. Amazon's return on assets, ROA, was initially low due to heavy capital investments in warehouses, logistics, and technology infrastructure. However, as these investments started to generate returns, ROA gradually improved, especially after 2018, signaling better asset utilization. For traders, a low early ROA could have been seen as a warning sign, but growth traders would have focused on Amazon's long-term expansion strategy rather than short-term profitability. The steady increase in ROA from 2019 onward confirmed that the company was efficiently generating profits from its assets, supporting a bullish outlook. By tracking ROA trends, traders can assess whether a company is effectively leveraging its assets to drive future stock growth. Amazon's current ratio remains stable just above 1, indicating balanced liquidity without excessive cash reserves. This suggests that the company effectively managed its short-term liabilities while maintaining steady operations. For traders, this liquidity position would have been viewed as neutral, neither a strong buy signal nor a major concern. Instead of focusing heavily on liquidity, traders would have prioritized profitability and growth metrics to assess Amazon's stock potential. Understanding the role of liquidity ratios helps traders determine whether a company is financially stable enough to support future expansion and stock price growth. Amazon's declining debt-to-equity (DE) ratio over the years signals decreasing financial risk and stronger financial stability. By 2021, the company had built enough retained earnings to self-fund much of its growth, reducing reliance on external debt. For traders, an improving DE ratio is a positive indicator, showing that the company is becoming more financially resilient. When combined with a high return on equity, ROE, this trend reinforces confidence in Amazon's long-term growth potential. By analyzing the DE ratio, traders can identify companies with strong balance sheets that are better positioned for sustainable stock price appreciation. Amazon's price-to-earnings (PE) ratio was extremely high in its early years, reflecting trader expectations of rapid future growth. While a PE ratio above 800 in 2015 may have seemed excessive, growth traders who recognized Amazon's long-term potential justified the valuation. As the company's earnings caught up with its stock price, the PE ratio gradually declined, reaching a more sustainable 58x by 2021. For traders, this shift indicated that Amazon had transitioned from aggressive expansion to a more stable growth phase. The PEG ratio helps traders assess whether a stock's valuation is justified by its earnings growth. In Amazon's early years, an extremely high PEG ratio suggested overvaluation relative to growth, meaning traders needed to look beyond this metric and consider macro factors like industry dominance, and AWS expansion. As earnings growth slowed post-2018, the PEG ratio remained above 1, indicating that much of Amazon's valuation was driven by market sentiment rather than fundamentals. By 2021, the combination of a more reasonable PEG ratio and improved profitability supported long positions for traders. Amazon's consistently high price-to-book PB ratio reflected strong market confidence in its intangible assets, such as technology and brand value, rather than just its physical book value. For growth traders, a high PB ratio was justified due to Amazon's strong future earnings potential and expanding market dominance. However, traders focused on undervalued stocks may have avoided Amazon during this period due to its high valuation relative to book value. Over time, as Amazon's earnings grew, its PB ratio gradually declined, indicating a more balanced valuation. Understanding PB trends helps traders determine whether a stock's price fairly reflects its assets and future growth potential. Amazon's stock saw explosive growth between 2015 and 2017, largely driven by high trader expectations, despite traditional metrics indicating overvaluation. Key macro factors such as e-commerce dominance and AWS expansion justified the stock's price surge. From 2018 to 2021, Amazon transitioned from rapid expansion to sustainable profitability, with improving profitability ratios, decreasing debt, and normalized valuation metrics supporting continued price increases. During this period, Amazon's stock price rose from around $300 to over $3,500 per share, fueled by strong fundamentals and macroeconomic tailwinds. This highlights how traders must analyze both financial metrics and broader market trends to identify high-potential stocks. When analyzing stocks, traders should look beyond financial ratios and consider macroeconomic conditions, industry trends, and competitive positioning. Amazon benefited from low interest rates, the shift to online shopping, and its market dominance, which reduced competitive threats. These factors played a crucial role in justifying high valuations during its growth phase, despite traditional metrics suggesting overvaluation. A combination of financial metrics and macro analysis would have helped traders make informed decisions about holding or buying Amazon stock.